Hey there, everyone. Dave Keller here with StockCharts.com, and welcome to this special all-mailbag edition of The Final Bar. We're actually currently en route back from Naples, Florida, visiting our family there for Thanksgiving holiday. Hope you guys all had a restful and wonderful Thanksgiving long weekend, opportunities to reflect and give thanks and be with loved ones. Getting back to the markets here, we wanted to start off the week here, finishing off the month of November, addressing some of the questions we've had. Great questions in our mailbag. And as a reminder, the mailbag's always open. Just shoot us an email, thefinalbar@stockcharts.com, with any questions that you have about technical analysis, about market history, about certain things you've heard or read or wherever. We're happy to point you in the right direction the best we can. With that, let's get to question number one. How important is the dollar for the market's next move? Really interesting question. We actually received a number of questions about the U.S. dollar and what that might mean, and I totally get it. And some will tell you that it is super important to think about. And if you've watched this show for a while, you know that in our market recap, we kind of go through the market overview, which is part of your dashboard on StockCharts.com. When we get to the bonds tab, we always look at what the dollar has done. We use the ETF, the UUP, but matches pretty well with the short-term movements in the underlying the U.S. dollar, which is the U.S. dollar versus other currencies, right? It's always a relative game when you talk about currencies. So I would probably argue that the direction of the dollar is less important than interest rates. I think the 10-year yield is probably the more important of the two. Now, there's a relationship between those two, which is probably outside the scope of what we can talk about in a short mailbag show. But I will tell you that relationship between the two is there. But when you think about, is it the dollar or interest rates, I would say one of the big stories in November has been the pullback in rates from the 10-year yield around 5% down to 4.5%, wherever it's at the moment. Now, here's a chart of the U.S. dollar, and if you think about what's happened in the last 6 weeks, that has changed, right, and taken our growth-oriented benchmarks from making new lows going into the end of October to all of a sudden, a lot of stocks making new highs, or at least getting near to their September or summer highs here toward the end of November. It's besides the fact that stocks have just stopped going down and started going up, which is very much a thing, and certainly the growth leadership leading the way. It's interest rates coming down, 10-year yield going from 5% down to 4.6%. It's the dollar coming down, right? Dollar going from around 107 and pulling back quite a bit to the 200-day moving average on this particular chart. Now, again, out of the two of those, I think the 10-year yield is the most important chart probably to watch outside of looking at the S&P and just thinking about, what will help you understand the macro environment. What's interesting about the dollar is there are times when the dollar and stocks actually move together. There are times when the dollar and stocks move apart. If you look in certain periods, the correlation between the dollar and the S&P is almost non-existent, right? It's actually a very fluid relationship. As much as we tend to think is a stronger dollar good or bad for stocks, it's usually part of a much bigger mosaic, I think, that is outside of the scope of what we could probably get at. I set up this chart here looking at the S&P 500, and at the bottom, I'm looking at the rolling 20-day correlation of the S&P 500 to the U.S. dollar. So you can see that's what we're doing here. And this is the line at the bottom. So I'm looking back at the last 2 years. And what you can see is with some, aberrations here where the correlation actually pushes a little bit above zero. For the most part, it looks like the average correlation is certainly inverse. And what that means is when the dollar's moving down, stocks tend to be moving up, and the opposite. When the dollar's moving up, stocks tend to be moving down. So I would say based on that traditional relationship, certainly the consistency of that relationship in the second half of 2023, I would say a weaker dollar is one of the things I would be looking for. Weaker dollar, lower rates, certainly part of it. Can the market rally on a stronger dollar? It certainly can. And if you look back in history, there have been times when it certainly has happened. Even late May into June, the dollar and stocks were going higher. Now, the dollar eventually rotated lower going into the summer, but there are periods where the dollar and stocks can go up. So just because the dollar spikes, I don't think that means the end of the world for risk assets, but certainly something to watch. And comparing the two of them again, I would say that the 10-year Treasury yield would be more important based on where I think we're at in the cycle here. Question number two. Why are you using SPY rather than $SPX in the denominator of a relative strength metric? I think you're talking about this when I bring up sort of my chart. And I do use other charts, but for simplicity on the final bar, this is kind of my go-to chart. And honestly, in normal conversation, when someone asks me about a stock like IBM, this is the chart I usually start with. And I often will go to other things and other visualizations to try to make sense of it. But I usually come back to something like this with price and the moving averages, with RSI, my favorite measure of momentum, and then this line, which is what you're asking about, which is the relative strength, which is essentially a ratio of the stock versus its benchmark. And for most investors, the S&P 500 is the benchmark to use. I know Grayson Rose uses the I think it's the VTI, which is another sort of broader equity ETF. I honestly think them as pretty much the same. The correlation between the two of them is about 99%, so pretty much the same thing. Other times, there are times when you may want to think about another benchmark, and that would be, if you're really looking at small cap stocks, you want to make sure you're picking the best small caps, so do relative to the IWM or something, and that'll be relative to a small cap benchmark. If you're thinking about your overall asset allocation, maybe do it versus a blended ETF or a blended mutual fund, and then you can see how well you're doing versus like a 60-40 stock to bond allocation. Those are times when doing it relative to something else can make sense. But in terms of an average go-to, how is this stock doing relative to others? I think the ticker :SPY is the way to go. Now, why am I using SPY down here and not $SPX? This just has to go with how the StockCharts platform actually considers dividends. So the $SPX, the S&P 500, actually does not include dividends in the calculation. It's just looking at the price action of the S&P, which is how it's calculated. It's not a total return index. The SPY, the dividends are reinvested as we chart it. So basically, we adjust the historical data series for a dividend payout. And what that means is it takes basically includes the dividend in the relative performance. So if you're trying to look at IBM versus S&P 500, what's your performance, your total performance, including price and dividends? This is the way to do it. If you do IBM $SPX, it's going to eliminate that. It doesn't make a huge difference necessarily. It depends on what kind of stock you're looking at and how big of a time frame you're looking at. But that's kind of the story. And the way you can see that, by the way, is if you look at if I bring up a chart $SPX, this is the ratio of $SPX versus SPY, and this line is just going slowly downwards, and that's basically the impact of the dividends, which are included in the denominator but are not included in the numerator, and that's why this line just goes steadily downward. So, again, if you're just looking at the direction of the relative strength, it's not going to impact things a lot, but over time, dividends really do matter, and so I always do the ticker :SPY, and that's my go-to, and I would suggest you do the same. Next question. Why does $DXY make a doji candle almost every day? I don't understand why it is demonstrating such an unusual phenomenon. So what's interesting, when you think about technical analysis, we are certainly trained, or you assume that all charts are the same. And what you learn as a professional technical analyst, I guess someone that's doing this and looking at thousands of charts every week for decades, you learn very quickly, and it doesn't take that long to learn that there are some nuances to different things, and certainly just within the equity space, right? The chart of a biotech stock versus a water utility, it's going to look totally different, right? They're just, the dynamics are different. You can tell the moment you bring up the chart that this is some different type of name just because of the nature of the price movements. Currencies have some unique characteristics. Commodities, and currencies because they're traded 24 hours. I'll come back to that in a minute. Commodities just because there's a rollover, and so you're actually doing some smoothing between different contracts, and there's a decay that's involved with that. ETFs have their own sort of subtle differences, and so you sort of learn the nuances. And even though a lot of the basic principles are the same, whether you're looking at a stock or an ETF or cryptocurrency or a commodity, there are some unique characteristics to those charts. We're going to look at $USD here again, and I'm going to bring up a candle style, a chart style that I have that focuses on candles, and I think you were just referring to these. What's all the doji candles here? You certainly see a lot of them, and a lot of overlap, right? There's not any gaps of any sort, which sort of looks different if you're used to looking at equities. So what you have to remember is with the there are a number of different things to think about. Dollars, the dollar tends to, or currencies trade 24 hours during the week, and so there's this overlap between trading sessions, and so during the week, it's actually not possible to not have, or to have a gap because one day basically goes right into the next, right? As a day progresses, you basically have a quick adjustment from one day to the next. And so just the way you calculate it, the way their charts are put together, there may be some little adjustments that are on there, but overall it's pretty much a continuous series. And so you're locking in a close. It's not like there's a formal close to the currency market. It just kind of continues trading. Cryptocurrency is kind of the same thing. So if you look at BTC USD, you're going to see a lot of overlap from candle to candle. No real gaps because it's not like there's a close and then a big open, right? I mean, these just keep going. And so one day's close rolls right into the next one. So some of the candle patterns you might be familiar with and might be looking for are going to be less common just because of that. And so I think the nature of how currencies and cryptocurrencies tend to trade, some of the subtleties with commodities, how you do the smoothing, can create some different looks. If you're used to looking at stocks and ETFs, what's interesting about those is you have a defined open, you have a defined close. Stocks open at 9:30 a.m. Eastern, they close at 4 p.m. Eastern. There's a gap from one close to the next morning. There's a weekend between each session. As a result, you can have this really choppy thing. And you also have things like earnings, which create a lot of big movements. The other thing to remember with something like currencies, you don't have like that quarterly earnings release. You have like economic data, but it doesn't usually create those big gaps like you would have, right? Like with equities, the market closes, you hear about earnings, then you reopen, and all of a sudden there's this big revaluation up or down based on what happened. Or news comes in before the market, all of a sudden it will cause this big gap. You don't really have those gaps in those markets that we just mentioned. So it has more to do with just the logistics of how currencies and commodities and cryptocurrencies are traded. That's why the patterns may look a little bit different. But as a reminder, I think some of the core, what we call like the founding principles, the basic principles of technical analysis, certainly hold true. Next question, IWF versus IWD shows investors not rotating into defensive sectors through 2023. Let's take a look, shall we? All right, so we're going to go to IWF versus IWD is looking at kind of growth versus value. So here's my chart that I look at. Yeah, so IWF versus IWD. This is the Russell 1000 growth ETF versus the Russell 1000 value ETF. As a reminder, this chart list that I use all the time on the final bar is called my Mindful Investor Live Chart List. You can get to that if you go to the top of your StockCharts and go to articles, go to my blog called The Mindful Investor. You can get to this list of charts. As a StockCharts member, which you all, of course, all should be, you can copy this into your own login and do some cool stuff with it as well. So here's the ratio of growth versus value. And what I would tell you is just a couple things. Number one, don't confuse growth versus value as offense versus defense, because they are two different things. What's happened recently, though, and I mean recently as in recent years, sort of post-COVID, growth stocks have been leadership, and even before COVID, to be honest with you, right? We think of offense as growth, right? Things like technology and communication services. I would argue that's our definition of offense has become growth because of a period of incredibly low and persistently low interest rates. In a rising rate environment, growth often isn't the offense that you want. It's more value-oriented stocks, things like industrials, materials, financials, healthcare stocks. These are things that can lead in a rising rate environment, sort of the cyclical leaderships. And those are more value. Those are actually in the denominator of this particular ratio. I would argue the reason why this ratio, growth versus value, is going up so much is because of the dominance of the mega caps. You have a chart here that shows you how the Magnificent Seven have dominated all else. If you look at the year-to-date returns of the Apple, Microsoft, Amazon, Netflix trade versus everything else, it's a big gap. And the way to see that, I mean, most obviously, just look at like a large cap growth ETF versus the S&P, or look at the top 50 Russell or the top 50 ETF versus equal weighted S&P, and you can see this big performance gap between the biggest names and kind of everything else. And those biggest names are all in the Russell 1000 Growth Index. That's what it's really showing you here. My preferred way of looking at offense versus defense, and to the punchline, it actually backs up your question. Your question is fine, which is you really haven't seen a rotation to defensive, and I think that is absolutely true. The defensive sectors you would be looking for, in my opinion, are consumer staples, real estate, and utilities. Those are like your pure defensive hideout and sort of, fetal position type of names to wait for an improvement in the markets. You saw a breakdown in these ratios toward the end of October, which was one of the things that caused me to, be a lot more cautious and thinking about the potential for further downside for stocks. That's totally changed. And again, staples really have not been a particularly strong place. Just look at food product stocks. Utilities have not outperformed in any meaningful or consistent way. Same with REITs. And those are the defensive, low volatility, high income names that tend to do well when the market is getting uncertain. So as this market is rallying, I would continue to look at ratios like this. Offense versus defense for me is XOY to XOP or RSPD to RSPS. Those are equal weighted versions of those consumer sectors, and look for that ratio to go lower. And it hasn't done it yet. Next question. Geopolitically speaking, we are seeing a bifurcation of the global economy, reversing the trend of globalization. How do the charts, notably in the S&P 500, account for this? That is a fascinating question. That could be a day-long, off-site seminar someday. Is get together with some smart people, and that's the question on the slide in the front, and we just talk about it all day. I'll put that on my list of fun things to do at some point when I'm a rainy day project. Just put something like that together. What's interesting, I think what you're hitting on, which is really interesting, is thinking about the relationship between U.S. to non-U.S. stocks, thinking about the relationship of the different pillars of the financial analysis toolkit. I think of investing as having four key pillars to your process. It's fundamental, technical, behavioral, and macroeconomic. And very quickly, those are the fundamental, what are companies doing and what are their prospects for growing earnings over time? The technical, what can the price of an asset tell me about the sentiment and the emotional state of investors and how their expectations are changing? The behavioral is really what's happening between your ears, right? What are you doing to make better decisions and not make poor decisions, or at least admit when you're wrong, which is a huge challenge for a lot of newer investors. And then the macroeconomic, the big picture, thinking about geopolitical risk, think about issues in the Middle East, issues in the Ukraine, and how those can impact asset prices. I think your question is getting in maybe to that four. And I should say there's a quantitative overlay to all of those, in my opinion. I think all of those things you can use statistical analysis and systems to automate things and make better decisions all around. But you're hitting on that relationship between the technical and the macroeconomic. And I would say not all macroeconomic ideas are reflected in price. And some of my peers probably would disagree with me there. But I would think there's a lot of times when there's a disagreement. For me, how is the bifurcation? I think what you're talking about is just the separation of like U.S. and China, right? For a while, sort of the global economy, everything's kind of moving together versus now where it feels like there's a big dispersion between them. I have a group of charts, where are they? Here, global stocks, where I'm looking at U.S., global developed, global emerging markets, frontier markets, and then a bunch of different global ETFs. And, there are times when these global ETFs all move together. If you just look at these preview charts on the candle glance function, you can see that Hong Kong FXI, which is large cap China, MCHI, which is another China ETF. These are some of the charts that look very different than global developed markets, right? You can see Brazil testing new highs, the S&P testing new highs for the year, China well below those previous highs. So I would say this is one of those times when, just China versus India, look at the big difference between China on the top and India on the bottom. So I think this is one of those times when China is sort of separated, is becoming, has a very different return profile than other markets. A lot of that has to do with a number of things. With China, you have a very different demographic setup, right? So China, the population is getting a lot older for a lot of reasons, but that is weighing on potential for growth because you don't have a lot of young people that are going to, hopefully innovate. A lot of the innovation, a lot of the growth stocks that are leading right now are U.S. based, right? It's sort of the U.S. technology that is innovating a lot more than globally. And so as a result, U.S. markets are able to benefit from AI and things like that, while China is more dealing with, upside down demographic curves and, a huge economic expansion, which is, potentially overexpanded. And now there are a lot of ripple effects with that. But I think that's something that, to be honest with you, has been, I think the idea of globalizing and there being one global equity thing is kind of laughable, and has been for a while. And one of those examples is EEM. I remember we were talking with one of the emerging markets portfolio managers at Fidelity years ago, and laughing about how, during the whole BRIC thing, there was a period where it was like the BRICS: Brazil, Russia, India, China, and these are like these four things all kind of move. These are the growing economies. I mean, those four charts could not look any different right now, right? Each one of them, Russia not even existent at the moment in terms of a tradable stock. So that's out. Brazil sort of chopping around because of the commodities. China very, very weak. India very strong. They're four very different charts. So summarizing those as emerging markets is not really appropriate. So I would say what you have to remember, I think global stocks are less like a soup and more like a salad bowl, right? It's sort of like a mix of different things that are all unique, and I still think they're very unique. But having said that, you can look at ACWI and get a sense of global stocks, which combines U.S. and non-U.S. I still think that's a fair way of just thinking about the overall equity market as a whole. But yes, very, very different. I would not say there's a lot of homogenous chart analysis, especially when you go outside of like the developed Western markets. Everything else, there's a lot of dispersion actually. And that's something that's actually a very good thing. Provides opportunities through ETFs, I think, that maybe previously we wouldn't have had. We're going to continue on with this special mailbag episode here in a moment. But before we do that, a couple quick announcements. First off, we welcome your feedback. This mailbag is fueled from people like you sending in your questions. A couple ways you can get your questions to us. Email is the best, thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. And on our YouTube channel, just drop a comment below the video that you're watching. We'd love to hear from you, and I hope to answer one of your questions in our next mailbag episode. Also, to let you know, we have a big time special happening right now. It is Cyber Monday today, and this is the best time you are going to have to renew your StockCharts subscription or start a new one. Go to stockcharts.com/special. If you are a current member, you can actually extend your membership at the lowest rate you're going to find. You can get up to 4 months free if you add to a current annual subscription. There are so many great features on the StockCharts platform, just 5 of them that I'll share with you very quickly. Number one, our scanning engine, right? One of the things that I do every week, and I actually just did it earlier today, is scan for stocks making new highs, new lows, scan for stocks breaking out, breaking down, looking for actionable buy and sell ideas. I use the scan engine pretty much every day. The ability to use scans to really dig through the equity ETF universe to find opportunities is only possible as a paid member of StockCharts. Our alert engine is super powerful. I use the alerts often. These are some of the alerts that have triggered for me recently. Anytime I'm looking at a chart and I see a particular level, a particular pattern, and I want to just make sure that I don't miss what's going to happen, you can allow a StockCharts, a platform like StockCharts, to do the work for you. Set an alert, you can go away. It pops up with a banner at the top of the website. It texts me on my cell phone. It sends me an email. I'm not going to miss an actionable move. So again, spend some time when you have time to do your research. Set those levels in your alert, and then let the StockCharts platform do the heavy lifting for you. That's another thing you can really only do as a paid member of StockCharts. ChartStyles are so valuable. I was looking earlier at a chart, and I was bringing up one of Gaddis Rose's ChartStyles, which really focuses on relative strength. Think about Intel, the semiconductor space, and just thinking about what Intel has done relative to other areas of the market. And on one chart, I can look at semiconductors versus technology. I can look at the leadership of a name like Intel versus the S&P 500. I can think about how Intel has done relative to other semiconductor names like AMD and NVIDIA. But this isn't the chart I look at all the time. It's just for certain times when I like to focus on it. And by being a paid member, you can actually go through and save tons and tons of different chart styles. Your candle glance page and your comparison charts can all have their own subtle differences. So chart styles are a third benefit to being a paid member. Market history is so valuable, and I love to use this historical chart gallery as the beginning of a really cool analytical process. If you go to the important market indexes, go to bonds, you can bring in deep history on treasuries and commodities and the equity markets. And by looking bigger picture, if you're just looking at the last couple weeks, even if you're a swing trader, you need to go back to market history and see what's happened during previous bull and bear market cycles. The only way you can do that on StockCharts, be a paid member. You can access some of the deeper history, save some of these charts and customize them, and really benefit from the lessons that charts can share with you about market history. Finally, we have members-only content that's pretty powerful. If you go to the articles tab, you'll see notes from John Murphy, notes from Martin Pring. These are two of the analysts that actually wrote some of the first books that I ever read about investing were written by John and Martin and others, and being able to dig into some of their content, see what they're thinking about the markets right now, and focusing on some of the ideas, again, that have stood the test of time. These are not new indicators that are just created. These are indicators that have worked through bull cycles, bear cycles, up markets, down markets, and being able to hear from John and Martin still publishing at this stage in their career is just such a pleasure. So again, those are 5 things you can really only do as a paid member of StockCharts. If you've never joined StockCharts as a premium member, I hope today is the day when you think about it. Go to stockcharts.com/special to find out all the information about our special Cyber Monday special. Let's continue on with this episode with the next question. What advanced decline metric would confirm the emerging uptrend? You're asking about the uptrend that you see in stocks. I'm going to go to the Mindful Investor live chart list here. We're going to look at some of the look at a couple of them. For me, I think the first off, when I think about breadth data and advanced decliners in particular, it has to do with just the trend in advanced decline data, right? In a bull market, in a bullish phase, the advanced decline data should be going up. Just the general trend in advancers versus decliners should be going up, because what is this chart actually telling you? This is the New York Stock Exchange, large cap, mid cap, small cap. And what this is doing is every day you have the number of stocks that closed up and the number of stocks that closed down. That's your daily advanced decline reading. We then accumulate those values over time to create a cumulative series, a cumulative advanced decline series. And that's what these charts are showing you for these different cap tiers. And again, can the market rally with most stocks not doing it? It can on a limited basis, and that certainly happened at times in 2023. But if you look back at market history, sustained advances, real bull market phases, involve a lot of stocks participating. It's not just a small number of names. It's a lot more that really start to follow suit and go higher. So just the simple trend in the advanced decline data improving, I think, is encouraging. So the trend in these going higher, the 50-day moving average on the advanced decline line sloping up, that's what we're seeing on the S&P, but we're not seeing it on the breadth data just yet. That's what I'd be looking for. Another one would be the McClellan oscillator, and this is more of a short-term indicator, but the McClellan oscillator remaining above zero is one of my basic, just plain vanilla, is the market strong or weak in the short term? If I had one chart to do, I would probably use this one, because when the McClellan oscillator is above zero, those are your upswings, and when the McClellan oscillator is below zero, those are your downswings. And we're in an upswing, which we are now. Simply look for when it gets below zero, and that on its own has helped get me out of the way of some really deteriorating markets. And it's not a lagging indicator. It usually happens pretty early because it's looking for a shift in the advanced decline data. So those are the two things I would look for. For now, I would say the advanced decline data pretty supportive. The McClellan oscillator getting below zero would make me a little bit concerned about the short-term strength. The advanced decline lines not improving from here would get me concerned about more of the medium-term time frame. Next question. I've always been fascinated by the Fibonacci sequence, but other than a self-fulfilling prophecy, how can it have any relevance to the possible pivot points for stock prices? This is a question I've gotten from the beginning of my investing career. I'm happy to share it with you. I'm just going to bring up a random stock. So what is the Fibonacci sequence? So what's funny is I learned about the Fibonacci sequence, and I've been fascinated as well. I learned about it when I was studying music as an undergrad at Ohio State, and was taught about the Fibonacci sequence. And you learn about it in two ways. One, the basic fundamental building blocks of music, certainly in the Western discipline, is all based on Fibonacci relationship. Things that we think sound good, right? Things like an octave or a fifth or a third, a chord, if you know music at all. Those things sound good pretty much to people across cultures, right? Those are not just a certain phenomenon in Western music, right? There's certain musical things just sound good to human beings, which is fascinating when you get into ethnomusicology, which is music of different cultures around the world. So what's interesting is there's actually a Fibonacci relationship. If you think about it, it's the third and the fifth and the octave, and all of these are based on the Fibonacci relationship. They actually immediately quickly come out. That golden ratio of 0.618 or 61.8% is all over music, whether you know it or not. And certain composers actually use that to their advantage, and they would often either intentionally or unintentionally incorporate Fibonacci points or Fibonacci relationships into their pieces as they were composing them. So it was very fascinating when I got to Bloomberg in New York and learned about technical analysis and was talking about the Fibonacci sequence again. I was like, wow, that was unexpected. So how does this work? I mean, so the general idea with Fibonacci retracements is that once you've had a significant move in a stock, you apply the Fibonacci relationships, right? So when you have the low and then you get to a high, these are some levels where you may expect support, right? 38.2% of the way, 50% of the way, 61.8% of the way. Those are the main Fibonacci levels. Now, why do these work? This is a source of endless debate in the technical analysis community. Some would argue the self-fulfilling prophecy that if enough of us have a clear Fibonacci framework on like the QQQ and we all bet on that to happen, I bet in some small way that certainly is creating that support that we might anticipate. I would say the same is to be said for pure support and resistance levels, right? There's a reason why United Healthcare gets up to its previous highs and then stalls out a little bit. I don't think that's a magical, mystical thing. I think that's just the fact that people know where the top was and they know we're up there again. And more often than not, stocks tend to find resistance at previous tops and they tend to find support at previous lows. That's pretty well-trodden path in technical analysis. The other argument is that there would be a rhythm to prices. And my sort of unproven hypothesis on this, having spent a lot of years talking with a lot of people that trade Fibonacci relationships, some like Tom DeMarco would say there's a rhythm in the markets and there's a natural relationship, just like you find it in music, you find it in stock prices too, and in a lot of data as well, in architecture and in anatomy. And there's a lot of places in the natural world and the shape of plants, you find Fibonacci relationships. But if you dig into the biology, which I have as much as I could, the Fibonacci relationship basically defines where leaves can be on a stem to get the maximum amount of water. If you want to know where to put them in the perfect place to get the maximum water onto each surface, it's the leaves being in a Fibonacci relationship. It's the seeds being in that relationship allows you to get the most into a certain place. So there's a reason why that things have evolved that way. For me, in terms of finding support and why United Healthcare might find support around 508 to 510 based on a Fibonacci relationship, I would think it's because that's a pullback, that's enough of a pullback that if the trend is still bullish, buyers are still willing to come in. Once you get back down about 50%, the chart looks bad. The stock has already given back a lot of the recent gains, and people see that as a negative sign. So whether or not the Fibonacci percentages are a magical, mystical formula, I would argue it's probably more about money management, and it's all about what this means about the move that has preceded the current move or the downtrend that preceded the current upswing, and how far we need to go for more buyers or more sellers to get into market. That's my hypothesis. I've not proven that in the academic circles, but maybe someday I'll do my PhD on the value of Fibonacci numbers, and I'll share it with you when I do. Next question. Disney has been trending positively, mostly since they reported their most recent earnings report. Do you see that trend continuing? Thanks for asking about a specific stock. A lot of these questions have been kind of bigger picture philosophical questions. Different takes on a stock like Disney. Of course, no recommendation on this. And I will give you the full disclosure. I do own Disney in a retirement account. I actually bought it down here because when Disney gets down into this range at a new multi-year low, and I just went to 2 Disney parks earlier this year. This spring, I went to Disneyland in California. Here over the summer, I went to Disney World, and that whole thing. I saw an incredible amount of money being spent. I saw the parks jacked full of people happily spending and very much enjoying a theme park again. For me, I came back and I'm like, Disney's getting crushed. I feel like this is a huge conglomerate that's going to be able to figure things out. There are obviously a lot of fundamental issues that have caused the price to go down to this point, but I see the long-term opportunity in a name like this, and so I bought some Disney in a retirement account. So far, it's gone pretty well, but this is a long-term play and more of a stock that I think is undervalued versus its possibilities going forward. Let's talk about the technical perspective, and I think what's most encouraging in the short term is the fact that we broke above this level right here. This was the support level. It's right around $85. This is the support at the end of 2022. This is where we bottomed out in the summer and bounced off of it. Then we broke below it in August, and then look at how many times we tested that level from below. Then we gapped above 85 and traded higher. And I think that's a really important price gap. This is on earnings. and then we've drifted higher from there. So gaps are really helpful, and I think gaps are important not just when they happen, but more importantly, what happens after the gap. Do you see additional buyers coming in, right? If Disney's a bearish chart, you gap higher, but then everyone's thrilled at just to get out at a little higher level, and you take profits and the price goes right back down. That happens sometimes. In a bullish phase, when investors are looking more risk on, they see gaps as a positive thing because these are actionable moves to the upside. And these are stocks that have potentially some further gains. So I'm impressed off of the run from 80 to 95. I think the challenge for Disney is, does it hold the 200-day moving average? The most recent move was a gap above the 200-day. So I would say the short term holding 90, which would be holding the 200-day, is important. Getting above that magical 100 number and staying above those May peaks around 102, 103, I think that would complete that potential bullish rotation, but still some to be proven there on a chart like Disney. Folks, that is our all mailbag special edition here for Monday, November 27th. Hope you guys are all doing well. Thank you guys so much, as always, for supporting the Final Bar and StockCharts TV. Before you leave, don't forget to like this video, subscribe to our StockCharts TV channel. We would so appreciate it very much. For StockCharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe. We'll be back live tomorrow, and we'll see you then.